Guys, there's a lot of great data coming out right now, but it could be all smoke and mirrors to see what's underneath the hood of what's going on in the economy. A lot going on today with a lot of news to discuss. First off, the market started off strongly down today with the NASDAQ down almost over 0.8%, but has nicely rebounded since then. There's been a lot of talk about what's been going on, and we're going to cover a lot of that today. First off, we have the Fed meeting tomorrow. According to the CME Group, there's a 95% chance of a Fed cut rate. That's a near lock. But I want to remind everybody, back in June of 2016, the Cavaliers were down 3-1 to the Golden State Warriors, and no team had ever come back from that in the finals, and they did. So anything can happen, but guess what's going to happen? They're going to cut rates. But the thing is, the rate cut is expected, but it's kind of difficult because we just also had an announcement today of retail sales. Let's go check out that data. The Census Bureau said Tuesday retail sales gained 0.7% in November from October, better than the analyst expectations of 0.5%. And even better than that, October's adjusted number came in at 0.5% versus the previous 0.4%. So retail is looking strong, but there's a note of caution in there. What's that caution? Well, I'll show you right now. 5 of the 13 categories that the Census Bureau tracks saw a decline in sales in November, especially among retailers selling non-durable goods. These include restaurants, bars, food and beverage, miscellaneous store retailers, and general merchandise. So what does that mean? Well, a lot of people speculate that it was a lot of people saying, listen, my budget's tight. I'd rather cut from these areas and go into buying my Christmas gifts, which makes a ton of sense. And retail is up 9.8% this holiday season versus last November. That's a huge jump. But before we get into more topics like SoftBank and Tesla and all-time highs, I want to show you something that I keep preaching on this channel and our main channel. This is U.S. retail sales going back to the early 90s. Guys, this is what it does. Yes, there was a blip here in the great financial crisis. Yes, COVID hit them hard. But I look at this saying, guys, everybody in the world talks about negativity. Oh, this bad thing, this bad thing. Yes, there's a lot of bad things happening. There's a lot of good things. And over time, our economy is going to get better. 68% of our GDP is consumer spending. Guys, we are a consumer society. The world isn't a consumer society yet. So imagine with 340 million people that we have versus 8 billion worldwide, what happens when these 8 billion people become consumer buyers? All the rest of them. Yes, there's still, Europe is very strong with consumers, but guys, retail sales are going to continue to get better and better. And my guess is over the next 30 years, it'll look like this again, starting at 628 billion and going to, I don't even know, could be 3 trillion, whatever it's going to end up being, maybe more. Now, earlier I'd said retail sales, its e-commerce sales are up 9.8% higher than last November. But remember, guys, e-commerce is growing much faster and being a much bigger piece of retail than before. Let me show you that data. Here is U.S. e-commerce sales going back to 2000. Just look at this growth. And of course, what was this big jump up? COVID. Now, back then we did COVID. We didn't know, is this going to be a permanent level or was it going to come back down? My personal opinion was it was going to come back down or grow much slower. But guys, COVID proved one thing. People loved doing online purchasing. And this is going to continue to grow. As you saw, it's 300 billion out of $697 billion. That's a big chunk. And my guess is that'll continue to grow even more. Now, guys, the same as I showed about the retail sales growing, this is Fed funds rate going back to the 1950s. Look at this and look at how long we were low for. This is why I laugh when I hear people say like, oh, just wait for rates to go back down to where they were recently. It's like, yeah, it could happen. And by the way, we could be in a longer state of lower interest rates as this economy takes a little bit more effort to grow. And in this time period, all the things that have happened in this world, all the things that have occurred, and guess where GDP has gone from here? Guess where the stock market has gone from here? Everything just continues to go up. And I talk about this because I always hear people saying, Paul, what's going to happen with this? What's going to happen with this interest rate? What's going to happen with this? Guys, all I care about is what's going to happen 10, 20, 30 years down the road. And my guess is that based on history, The US economy is going to be much, much larger 10, 20, 30, 40 years down the road than it is today. Per capita income will be much higher 20, 30, 40 years down the road than it is today. These are the things that drive the economy. These are the things that are going to drive stock values, because the more we make, the more we're going to buy, because we're 68% consumer spending. So with the talk of interest rates lately, we saw a massive run up in interest rates and then now a decline. And we're looking at a potential 0.25% cut in rates here coming this week. With that said, the question becomes is what's the right interest rate? Well, there is a stable interest rate that economists talk about. Is it easy to get to? No, it's difficult, because a stable rate means, hey, what's the rate it needs to be where it doesn't cause massive growth and inflation and doesn't slow down the economy? We don't know what that rate is. And my guess is, and this is purely speculation, my guess is that as our economy gets larger and larger, that rate is going to be changing over time. It's a balancing act that the Fed has to balance. Now, I was just at lunch yesterday with a good friend of mine, and he's been pretty spot on about economic high-level things for a while. His thought is that he thinks Fed Powell is going to keep cutting rates because Powell's done in March or April of 2026, and he does not want to leave on some sort of bad recession. So the best way to keep kicking the can down the road is to keep cutting those rates. Is he right? I have no idea. It makes sense considering how much Powell is on the forefront of the economy and interest rates day in and day out. He's in the Wall Street Journal. He's on Market Watch. He's on Yahoo Finance. He's on Barron's every single day. And at some point, with so much exposure to the public, you want to make sure that you're not being blamed for anything down the road. And our incoming president, President Trump, has been talking about how he wants lower rates, which is a lot different than he said before he even ran for president back 9-10 years ago. But now he wants lower rates because he wants to boost the economy, which also was announced in addition to the investment from SoftBank for $100 billion. Now, if you remember, back in 2016, SoftBank announced a $50 billion investment in the U.S., trying to generate a ton of jobs, 50,000 jobs. This one, they're trying to generate 100,000 jobs. So first off, before we go into that any further, can you imagine how much 100,000 jobs would generate for the economy? It would be $3 or $4 billion a year just in tax revenue for the U.S. economy. So not only is SoftBank going to bring money in, they're going to go raise money from investors and go invest it in AI-driven companies, tech companies here in the U.S. But then the U.S. taxes the jobs that are created. The question is that likely? Well, guys, tech tends to be a low per employee revenue sector. What that means is you don't need to have a ton of employees to generate a lot of revenue in tech. And I think over time, it'll be less and less and less. And remember, these are also politicians, and SoftBank is a company that's trying to raise money, so they want to really hype things up. Is it likely to be that good? I have my skepticism on that. Could it happen? Sure. Trump at the press conference tried to bully SoftBank into investing $200 billion, to which they said, we will try our best to do that. Listen, I personally love the fact they're going to try to invest, even if it's a 50 or 60 extra billion dollars in the U.S., it's still driving innovation, because the time I'll be worried about the U.S. economy is when I see people leave this country for entrepreneurship and for innovation in other countries. That'll be a time where I go, what's going on here? So guys, remember, there's a lot of stuff going on, a lot of moving parts. We want you to stay on the bigger picture, which is the economy growing? What does it look like 10, 20, 30 years from now? And can you pay a reasonable price for your investments? You can by dollar cost averaging. Yes, you're going to probably overpay today, but in the long run, you're going to pay exactly what the market's going to do over that period of time. Thank you for your time.